You know how so much of our modern world relies on these digital systems humming away in the background? Systems for payments, records, keeping track of, well, everything.
Oh, absolutely. And often they're built on traditional centralized databases, things that have been around for
These
ages.
work, mostly, but sometimes they feel a bit like black boxes, maybe even a little fragile?
Exactly. They have inherent limitations: speed, cost, sometimes even trust.
Well, today we're digging into a technology that's trying to fundamentally change how we build those digital foundations. People often think crypto, but it's much, much bigger.
We're talking about blockchain.
Yes. So in this deep dive, we're unpacking blockchain, what it is, how it works, its challenges, and its, well, surprisingly broad real-world impact.
That's the plan.
Yeah,
And we've got a good range of sources to draw from.
we do. Foundational stuff from Investopedia, technical comparisons from Xenonstack, deep dives on finance from Consensus and PwC, challenges from Finextra Research, and a close look at a specific project, Mojaloop, from the Mojaloop Foundation itself.
Our mission here, for you listening, is really to cut through the hype and the jargon, distill what's essential from all this material.
Make it accessible, right? Highlight some maybe surprising insights and show the different angles on where this is all going.
Exactly. We want you to quickly grasp the core ideas, understand the big problems blockchain still faces, and there are some big ones, and then see a really concrete example of how it's being used.
Yeah, that Mojaloop example sounds fascinating, tackling something vital like financial inclusion.
So we'll start with the basics. What is this thing? How does it
Okay.
work? Then zoom out to the potential before hitting those hurdles, how people are trying to fix them, and finally, that Mojaloop deep dive.
Okay, let's unpack this then. Starting right at the beginning. What is blockchain fundamentally? What's happening under the hood?
Okay, so at its simplest, blockchain is a type of database, a digital ledger.
But not like a normal database stored in one place.
Exactly. The key difference is it's decentralized. So instead of one company or bank controlling it, copies are spread out across many computers on a network. We call these computers nodes.
And it uses blocks to store data, not tables.
Correct. Data, like transaction records, gets grouped into these blocks, and they're linked together chronologically
Hmm.
using cryptography. That's the chain part.
Cryptography, like digital signatures and stuff?
Sort of. It uses cryptographic hashes. Think of it like each block gets a unique digital fingerprint, a hash. And crucially, each new block also contains the hash, the fingerprint, of the block that came before it.
Ah, okay. So if you tried to mess with an old block.
The fingerprint would change.
Yeah.
And the next block in the chain would still have the old incorrect fingerprint recorded, so the link breaks.
And everyone on the network sees that mismatch.
Instantly. Their copies wouldn't match the altered one. The network rejects it. It makes the chain tamper evident.
So that's immutability. Once it's in, it's basically set in stone.
Pretty much. For large, active networks, it's designed to be irreversible. You can add new blocks, but changing history is incredibly hard. Almost impossible, practically speaking.
Which leads directly to security, I guess.
Yes. That cryptographic linking is the core, each block confirming the one before it. To change history on a public chain like Bitcoin, you need to redo the math for the changed block and all the blocks after it, faster than everyone else.
Which means controlling most of the network's computing power.
Over 50%.
Yeah.
Yeah, the so-called 51% attack. Highly improbable for really big networks today.
Okay. And transparency. You mentioned public blockchains.
Right. Many, like Bitcoin or Ethereum, are public. Anyone can join, run the software, and see the whole transaction history.
But not necessarily who made the transaction.
Generally, no. You see the wallet addresses involved, which are like pseudonyms, strings of letters and numbers. Your real-world identity isn't usually tied directly to the address on the chain itself unless you link it somewhere else.
Okay, makes sense. So how does a new block actually get added? Let's stick with the Bitcoin example the sources use.
All right, so someone sends Bitcoin. That transaction gets broadcast out to the network. It waits in like a holding area called the memory pool.
A pool of unconfirmed transactions.
Exactly. Then you have participants called miners. They grab a bunch of these transactions from the pool to make a new block.
Is there a limit to how many they can grab?
Yes, Bitcoin blocks have a size limit around 4 MB currently. That's important for scalability, which we'll definitely get back to.
Right, the speed issue.
Yeah. So the miner puts the transactions in a block. They run all that data through a cryptographic hash function. This creates that unique fingerprint for this block.
The block hash.
Right. And that hash is generated using the transaction data, some other info, and crucially, the hash of the previous block. That's the link.
Okay, linking it back. Now, how does it get officially added?
This is the proof of work part. Miners compete. They have to find a specific random number called a nonce.
A number used once.
Yeah. They add this nonce to their block data and hash it all together. They keep trying different nonces until they find one that produces a hash meeting, a specific target set by the network.
Like a hash starting with a certain number of zeros?
Essentially, yes. It's like a lottery, but you win by doing computational work, guessing trillions of hashes per second. It takes huge amounts of electricity and processing power.
Wow. Okay, so the first miner to find the right nonce wins.
They win. They get to broadcast their completed block to the network. Other nodes check it's valid, and if so, they add it to their copy of the chain. The winning miner gets rewarded with newly created Bitcoin and the transaction fees from the block.
So the block's added, transaction complete, instantly.
Well, it's in a block,
Huh.
but it's not considered fully confirmed or secure right away. You need more blocks added after it.
Why's that?
It makes it exponentially harder to undo. For Bitcoin, the standard is typically 6 confirmations, meaning 6 more blocks added on top of the one containing your transaction.
And since blocks are roughly 10 minutes apart, that's about an hour.
About an hour, yeah. To reverse your transaction then, an attacker would need to redo the proof of work for your block and all 6 blocks after it, faster than the entire rest of the network. Basically impossible.
It's amazing, really. A distributed system creating trust without a central bank or company checking everything.
That was the whole point. Satoshi Nakamoto's original Bitcoin paper called it a new electronic cash system, fully peer-to-peer, with no trusted third party. Bitcoin uses the blockchain as that shared ledger, mainly for transactions.
But as you said, the sources emphasize it's way bigger than just money.
Oh, definitely. Because you can record any data immutably. Think votes, medical records, property deeds, where your food came from, anything you need a secure, trustworthy record of.
Okay, let's talk applications then. Some of these examples are really interesting, like supply chains.
That's a great one. IBM's Food Trust, which companies like Walmart are using, they trace products, say lettuce, from the farm right to the store shelf.
What's the big advantage there?
Speed and trust. If there's an E. coli outbreak, finding the source with paper records can take days, even weeks. With blockchain, you could potentially trace it back in seconds, pinpoint the contaminated batch much faster, issue targeted recalls. That could literally save lives.
Wow. Okay, that's impactful. What about voting? That's always a hot topic.
Huge potential there. Secure, transparent, verifiable elections. Each vote recorded as a token on the chain could drastically reduce fraud concerns, eliminate counting errors. The sources mentioned West Virginia did a small pilot for overseas military voters back in 2018.
Interesting. And property records sounds like something that could use an upgrade from dusty old filing cabinet.
Definitely. In many places, property records are manual, prone to errors, slow, even vulnerable to corruption. Storing deeds on a blockchain could create a permanent, accurate, easily verifiable record of ownership.
Especially useful in places maybe without stable governments or after conflicts.
Exactly, helping people prove ownership securely when traditional systems are weak or destroyed.
Healthcare records, too. Privacy is paramount there.
Yeah, blockchain could offer secure storage. Patients control access with a private key, and the immutability gives confidence that records haven't been tampered with.
And you mentioned smart contracts briefly. What are those again?
Think of them as automated agreements written in code on the blockchain. If X happens, then automatically do Y.
Like an escrow that releases funds automatically when delivery is confirmed.
Perfect example.
Oh.
Or automatically paying insurance claims when specific weather data triggers are met. It removes the need for intermediaries to enforce the agreement. The code handles it.
It does feel like finance is where so much focus is, though.
It is. The potential for faster, cheaper, more secure financial operations is massive. And that Mojaloop project we'll get to later is a prime example of applying these ideas to solve really big financial access problems.
Right. But let's not get ahead of ourselves. Before the potential, the problems. Because it's not all smooth sailing. The big one everyone mentions is scalability.
Yeah, scalability is probably the single biggest technical hurdle holding back really widespread mainstream adoption right now.
And scalability just means handling more users and transactions.
Basically, yes.
Yeah.
It's the network's ability to handle growth, more transactions, more data, more users efficiently and quickly without compromising security or that core idea of decentralization.
And there's this blockchain trilemma concept, hard to get all three.
That's the idea. It suggests it's really tough to maximize decentralization, security, and scalability all at once. Usually you have to make trade-offs, improve scalability, maybe you sacrifice some decentralization.
So what does that look like in practice? You mentioned Bitcoin's block size limit.
Right. That leads to limited throughput. How many transactions per second, TPS, the network can handle. Bitcoin manages maybe 7 to 10 TPS. Compare that to Visa, which can handle, what, tens of thousands?
65,000 PPS, the sources say. That's a huge difference.
Massive. You can't run a global payment system for billions of people at 7 TPS.
And that low speed causes other issues, congestion.
Exactly. When lots of people try to transact, the network gets clogged. Transactions take longer to get into a block and be confirmed, and fees go up.
Why do fees rise?
Because block space is limited. Users essentially bid against each other, offering higher fees to incentivize miners to include their transaction in the next block sooner.
Okay. And the blockchain itself just keeps getting bigger and bigger.
Yes, the data storage issue. On many public chains, every full node stores the entire history. Bitcoin's chain was over 600 gigabytes by late 2024. That gets demanding. Requires more storage space, bandwidth to sync. It raises the barrier to running a node, which could impact decentralization over time.
Are there other major drawbacks people worry about?
Definitely. The cost and energy consumption, especially for proof-of-work chains like Bitcoin. We mentioned the massive electricity use.
Exceeding Pakistan's annual consumption, one source noted. That's staggering.
It is. Though it's fair to mention the industry is working on greener solutions, using renewables, capturing flared gas from oil fields, things like that. But energy use is a persistent concern.
What about the association with illegal stuff? Silk Road and all that?
Yeah, that history exists. Because of the pseudonymity, early on it was used for illicit markets. But context is important here. The sources point out that in 2023, illicit activity was only about 0.34% of all crypto transactions.
Tiny fraction, really.
Relatively tiny, yes. And untraceable physical cash is still a much, much bigger channel for illicit finance globally. Plus, regulated exchanges now have strict KYC/AML rules, similar to traditional banks.
Know your customer and anti-money laundering.
Right.
How about government regulation? Is that still a big question mark?
There's definitely still regulatory uncertainty in many places. Governments are catching up. But the general trend seems to be focusing regulation more on the products built on blockchain, like crypto assets, exchanges, stablecoins, rather than trying to ban the underlying technology itself.
Seeing it more as infrastructure?
Kind of, yeah. Like the internet. You regulate what people do with it, not the internet protocols themselves.
And finally, public perception must be tough after things like FTX collapsing.
Absolutely. High-profile failures and scams have definitely damaged public trust. The sources mention a significant percentage of people saying they'll never buy crypto. Overcoming that skepticism is a real challenge for wider adoption.
So, okay, serious hurdles. Scalability, cost, energy, regulation, trust. But the industry isn't just, throwing up its hands.
Not at all. There's a huge amount of effort going into solving these problems, especially scalability. It's probably the most active area of blockchain development.
How are they tackling it? Are there different kinds of solutions?
Yeah, we can group them into a couple of main categories. First, you have layer 1 or on-chain solutions. These involve changing the main blockchain protocol itself.
Tweaking the fundamental rules.
Exactly. One example is segregated witness, SegWit, which Bitcoin implemented. It basically rearranged how signature data was stored in transactions to make more room in each block. Simple idea, but it increased capacity.
Okay. What else for layer 1?
Then you have hard forks. These are bigger changes, like increasing the maximum block size or making blocks get produced faster. But these can be controversial. If the community doesn't agree, it can split the chain into two separate versions.
Contentious. Okay, so that's layer 1. What about layer 2? That sounds like building on top.
Exactly. Layer 2, or off-chain solutions, the core idea is maybe not every single transaction needs to be recorded and validated by the entire main network immediately. You can do stuff off the main chain, faster and cheaper, and then just settle the final results back onto layer 1 periodically.
How does that work? Give me an example.
One type is sidechains. Think of them like parallel chains linked to the main one. They can run faster, have different rules, maybe use a less energy-intensive consensus mechanism. They process transactions independently and then kind of bundle up the net results and record them on the main chain. Plasma on Ethereum or Polkadot's parachains fit this model.
Interesting. I've also heard of the Lightning Network for Bitcoin. Is that layer 2?
Yes, that's a prime example of another type called state channels. Imagine two people opening a private payment channel between them off the main Bitcoin chain. They can send tiny payments back and forth instantly, millions of times, with almost no fees.
Without hitting the main blockchain each time.
Right. Only when they decide to close the channel does the final balance horse, the net result of all those tiny payments, get recorded as a single transaction on the main Bitcoin blockchain. It's great for micropayments, streaming money, gaming rewards. Raiden network is similar for Ethereum.
Okay, sidechains, state channels, any others?
The sources also mention nested blockchains, where you have a main chain setting parameters and secondary chains operating underneath it, handling specific tasks and reporting back.
And there's work on the consensus mechanisms themselves, right? Moving beyond proof of work.
Huge area. Things like proof of stake are much more energy efficient. Also, protocols focused on interoperability, getting different blockchains to talk to each other, like Polkadot or Cosmos. If chains can seamlessly exchange assets and data, the whole ecosystem becomes more scalable.
So it's like attacking the scalability problem from lots of different angles. Layer 1 tweaks, layer 2 systems, better consensus, connecting chains, all trying to balance that trilemma.
Exactly. Trying to get more speed and capacity without giving up too much on security or decentralization. It's an ongoing evolution.
Okay, so despite the challenges, let's swing back to finance. Because the potential impact there seems really profound, according to the sources.
It really does. The traditional financial system has layers of intermediaries, legacy tech. It's often slow, expensive, and complex. Blockchain offers potential fixes across the board.
Like what specific benefits?
Well, enhanced security, for one. Distributed ledgers are inherently harder to attack than single, centralized databases. Smart contracts add programmable security. Then there's transparency. Shared ledgers can give all parties the same view of the truth, reducing disputes.
That builds trust, presumably.
It does. When everyone sees the same immutable record, it fosters collaboration. And programmability via smart contracts lets you automate complex financial agreements and processes reliably.
What about privacy? Finance needs confidentiality.
Good point. While public chains are transparent, many enterprise blockchain solutions have robust privacy tools. They allow selective sharing of data only with authorized parties within a network, balancing transparency with confidentiality.
And the sources talk about digitizing assets on the blockchain.
Yes, that's key.
Yeah.
Representing traditional assets, stocks, bonds, real estate, even money itself as digital tokens on a blockchain unlocks huge efficiencies.
And economic benefits, like lower costs.
Definitely. Automation reduces operational costs, transaction fees, the need for reconciliation. It also improves market reactivity. Issuing a new digital bond could potentially take hours instead of weeks. Securities can be customized faster to meet specific investor needs.
And it opens up totally new possibilities.
For sure. Things like fractional ownership. Imagine owning a tiny slice of a commercial building. Or tokenized microeconomies. Near instant global settlement of trades instead of waiting days. These are new products and markets enabled by the tech.
Okay, let's get specific. Which parts of finance are seeing the most action or potential?
Capital markets is a big one. Speeding up everything from issuing securities to trading, clearing, and settlement, reducing counterparty risk, freeing up trapped capital, especially relevant in emerging markets with less developed infrastructure.
What about managing investments, asset management?
Streamlining things like fund administration, managing investor records, cap tables, transfer agency. Smart contracts can automatically enforce fund rules or complex fee structures, improving governance.
Payments and remittances, we touched on this. Slow and costly today.
Huge potential here. Cross-border payments taking days and costing 7%. Blockchain could enable near real-time settlement at a fraction of the cost. Think faster P2P payments, business payments, even aid distribution, with built-in compliance checks.
Banking and lending, too. Mortgages take forever.
Right. Processes like loan syndication, underwriting, disbursement. Blockchain could streamline them, reduce paperwork, cut settlement times drastically, mortgages taking days instead of months, SME loans funded much faster. That's the promise.
And trade finance. All that paper.
Massive inefficiency there. Letters of credit, bills of lading, often physical documents shipped around the world. Digitizing these on a shared, trusted ledger could cut processing times from months to days, reduce fraud, free up working capital for businesses.
Even insurance.
Yes, secure data verification for underwriting, faster, more transparent claims processing, using smart contracts for automated payouts like parametric insurance based on weather data triggers, even creating more efficient markets for reinsurance.
And finally, compliance. A huge burden for financial firms.
Blockchain could help automate it, program compliance rules directly into digital assets, automate regulatory reporting, provide auditors with immutable real-time data trails, reduce errors and costs.
Wow, it really cuts across almost every part of finance. Which brings us to Mojaloop. This sounds like it's taking these ideas and applying them very directly to a specific, massive problem.
It is. Mojaloop is a really compelling case study. It's open source software designed to create interoperable payment systems. Basically, getting different financial players banks, mobile money operators, fintechs, to talk to each other seamlessly.
And its origin is specifically about financial inclusion, started by the Gates Foundation.
Exactly. Launched in 2017 with that clear goal, universal financial inclusion, giving everyone, especially the unbanked and underbanked, access to affordable digital financial services.
Tackling that last mile problem, reaching people who rely on cash.
Precisely. Cash works, it's instant, but it's hard to use remotely, risky to carry, expensive to manage. Mobile money has been huge in bridging this gap over the last decade.
Right, using simple phones and local agents.
Yeah, the scale's incredible, hundreds of millions of active users.
Yeah.
And research shows it helps lift people out of poverty. But there's a problem.
Even with mobile money.
Often these systems don't talk to each other. Money gets stuck. You might have an account with one provider, but you can't easily pay someone using a different provider or send money smoothly between your mobile wallet and a bank account. It's fragmented.
Siloed ecosystems.
Exactly. Which leads to delays, high fees sometimes, lack of trust when things go wrong, inefficiency for businesses managing multiple accounts. It holds back the potential.
And Mojaloop aims to fix that fragmentation.
That's the core idea. It provides that missing interoperability layer, a shared set of rules and technical standards, APIs, that allow all these different players to connect and transact in real time. It's like a blueprint for a national payment switch focused on instant, low-cost payments.
Based on instant push payments, like cash, but digital.
That's key. The user initiates the payment, funds move instantly, the recipient gets immediate access, it builds trust and mirrors the cash experience people are familiar with. Mojaloop's design enables this effectively.
I saw GDP Connect mentioned too. Is that part of Mojaloop?
It's a related initiative, using Mojaloop and other open-source tools, digital public goods or DPGs, to create a blueprint specifically for governments to send payments, like social benefits, directly to citizens' accounts, efficiently and transparently, leveraging that same interoperable infrastructure.
Okay, so how does Mojaloop actually achieve this interoperability and address those fragmentation problems? What are its design principles?
Several key things. It provides standardized clearing rules and APIs. Everyone agrees on how transactions work. For liquidity management and settlement risk, a huge issue in real-time systems, it has a central hub function.
What does the hub do?
It tracks the net position of every participant in real time. Crucially, it enforces net debit caps. Before any transaction happens, it checks if the sender's institution has enough headroom or pre-funded collateral to cover that payment within the system settlement process.
Like a real-time risk limit.
Exactly. It prevents participants from building up huge debts they can't settle later. This happens per transaction. It minimizes settlement risk drastically. It also supports frequent multilateral net settlement, maybe multiple times a day, reducing exposure. And it uses cryptographic signing, using the interledger protocol, for non-repudiation.
Interledger, that sounds like connecting different ledgers.
That's the idea behind it. It's a protocol designed for payments across different networks. Mojaloop uses it to ensure payment instructions are cryptographically secured and can't be denied later, which reduces the need for painful manual reconciliation between participants.
Is the Mojaloop software itself flexible? Can it be adapted?
Yes, modularity is a core principle. It's built with microservices designed to be independent of specific hardware or cloud providers. This avoids vendor lock-in and lets schemes adapt it over time.
And it focuses on actual use cases.
Right. Business and use case focus, designed to support common transactions like P2P, paying merchants, P2P, receiving government payments, G2P, bulk payouts, cash in out, helping schemes measure their real impact.
What about privacy and cybersecurity? Handling financial data securely.
Built in from the start, privacy by design, cybersecurity by design. It uses open standards, has a technical governance board, and being open source helps more eyes on the code to find and fix issues quickly. Importantly, the central hub minimizes the personal data it actually stores. It focuses on the value transfer.
How do you make sure you're sending money to the right person without a central directory of names?
Through confirmation of payee. The protocol includes a step to look up the recipient's name before sending funds. But the actual name data stays with the recipient's own financial institution, the DFSP. They're the source of truth, not the central hub.
Clever. Decentralizing the personal info. Can it do real-time checks, like for AML or spending limits?
Yes, the design supports transaction rules. Schemes can implement checks during the transaction flow for KYC/AML flags, velocity limits, account status before the money actually moves.
And transparency, especially around fees.
Built into the API design, users should see the fees up front. The system also provides data for scheme compliance and dispute resolution.
Does it handle complexity like different currencies or cross-border?
It has multi-currency support built in and is designed with cross-border readiness in mind. The sources mention its potential alignment with international initiatives like the BIS Nexus Blueprint for connecting domestic instant payment systems.
The open source digital public good DPG model seems really important here. Why is that such a good fit for financial inclusion?
It's huge. Being open source means transparency. Anyone can inspect the code. As a nonprofit DPG, it can receive philanthropic funding for development and deployment support, which is crucial in resource-constrained
It
markets.
lowers costs.
Dramatically. No core software license fees. It allows for local customization and fosters competition among local tech providers who can support and extend it. This reduces costs across the board: development, support, operations. The community focus also minimizes onboarding costs. The goal is to connect a new financial provider in potentially just a couple of weeks.
That's fast. So where is Mojaloop actually being used? What's the real world status?
Well, as of early 2022, when some of these sources were published, pilot projects were moving forward. Places like Rwanda with our Switch and another called WinePay. They had finished technical testing and were starting user testing and proofs of concept with local financial institutions, focusing on specific use cases like P2P or loan repayments. It's moving from concept to reality.
It really ties it all together, taking blockchain principles like standardized protocols, real-time settlement, cryptographic security, and applying them pragmatically with this open source model to solve a massive real-world problem.
Exactly. It shows the potential isn't just theoretical. It's about designing systems thoughtfully to connect existing players and build a more inclusive digital financial ecosystem. It leverages the ideas of shared ledgers and interoperability without necessarily requiring a full-blown decentralized blockchain for the core clearing, addressing some of those scalability and governance challenges differently.
So reflecting on this whole deep dive, we started with the basics of blockchain, that decentralized, immutable ledger idea.
Right. Then explored its potential far beyond crypto supply chains, voting, records.
Before hitting the hard realities, the challenges, scalability being the big one, that trilemma plus cost, energy, trust issues.
And then looked at how the industry is actively trying to solve those challenges with Layer 1 and Layer 2 solutions, new consensus ideas, interoperability.
Which brought us back to finance, where the potential seems immense, leading into that detailed look at Mojaloop as a concrete example of applying these principles for financial inclusion.
Yeah, using interoperability and smart design to connect the unconnected.
It really feels like, while blockchain technology itself is still very much evolving and facing those hurdles, the work happening both on the core tech and in applications like Mojaloop shows its power to create better digital systems, more secure, transparent, efficient.
And potentially much more inclusive. It's not just theory, it's being built and deployed to tackle tough, real-world problems right now.
Which leaves us with a thought, perhaps. Given this global drive for instant digital payments, for connecting everyone, how might that balance that trilemma between decentralization, security, and scalability need to evolve or shift in the future?
What trade-offs will we need to make, or what innovations will need to emerge to truly build a digital economy that works for everyone, everywhere?